Good morning, everyone. Thank you for being with us today. We're going to start our webinar now. Thank you for joining us. I'm Deepshikha Dutt. I'm a partner in Denton's Litigation and Dispute Resolution Group, and I co-lead the firm's National Professional Liability Subgroup. My practice focuses on working with insurance companies and representing various professionals in liability claims, regulatory investigations, and complex class actions. Today, I'm joined by my colleagues. First, Kelly Osaka, a partner in the Denton's Litigation and Privacy and Cybersecurity Group in Denton's Calgary office, known for her leading practice in complex commercial disputes, class actions defense, and privacy risk management. She regularly advises clients across industries, including financial services, on regulatory compliance, cybersecurity readiness, and navigating high-stakes litigation and privacy incidents. We also have with us Mike Beforth. Mike is a commercial litigator and partners in Denton's Litigation and Dispute Resolution Group in our Toronto office with deep experience advising financial institutions, including Mike did a secondment at a major Canadian bank and managed their litigation and regulatory matters. Mike has appeared in all levels of court in Ontario, as well as the Supreme Court of Canada, and frequently deals with regulators across the financial service sector. Let's dive into our session today, which is an overview of legal and regulatory obligations of wealth management professionals. First, Mike, in order to situate ourselves and before we dive into what the risks are faced by wealth management professionals, can you perhaps walk us through what are the duties that wealth professionals owe and to whom? So perhaps we can go to the first slide for that.
Sure. Thanks, Deep. I'm going to be speaking today primarily about the relationship between advisor and client, so investment advisor and their clients, though these duties apply as well to trust professionals, other wealth management professionals generally. And the core duty that exists at law is a duty of care, which derives from the negligence, the law of negligence. And this is probably old hat to a lot of people on this call. But in brief, a duty of care is a legal obligation to take reasonable care to prevent foreseeable harm to others. And IAs, as well as other professionals, will owe their clients a duty of care. Now, the extent of that duty depends on the facts and nature of your relationship, but generally, it will encompass an obligation to execute instructions and to act honestly. It may also, in most cases, include an obligation to take reasonable steps to identify conflicts and disclose those to your clients, as well as to uphold and respect the confidentiality of client information. How do you meet your duty of care? Well, you need to perform in accordance with the standard of care, which is the level of prudence and caution that an advisor must exercise to meet that duty. And it is fact dependent, as many things are in litigation, but generally, an advisor must execute a degree of care, skill, and diligence that would be expected of a reasonable and prudent advisor in the circumstances. Now, what that standard is will depend on the advice that is being given, the sophistication of the client's experience, the level of reliance that the client places in the advisor, which we'll come to in a moment. But in circumstances where an advisor or a professional is found to have failed to meet the standard of care, they will likely be found negligent and be responsible for any resulting losses. Now, before we go to the next slide, advisors, in addition to the common law duty of care, will also have obligations under their client account agreement, though these obligations are generally more circumscribed than the obligations owed under the duty of care. Now, most account agreements will include limitation of liability clauses that seek to circumscribe an advisor's common law duty of care. The enforceability of those clauses will depend on the facts, the nature of the relationship, and the advice given. And generally, the more reliance that a client places in the advisor, the less likely it is that those clauses will be upheld by the courts. And that's a good time to go to the next slide, please, which deals with a fiduciary duty. So this is a greater duty held by certain advisors in the wealth management realm. And the seminal case dealing with fiduciary duty in the context of wealth management and investment advice is the Supreme Court's decision in Hodgkinson and Sims from 1994. And in that case, the court recognized that the relationship between an advisor and a client exists on a spectrum. On one end, you have total independence, where the advisor is little more than an order taker. And on the other side, you have a situation where the client relies entirely on the advisor to provide them with advice. And in situations where an advisor effectively makes decisions on behalf of their client, either because of that degree of trust and reliance reposed in the advisor, or because it's a managed account, a fiduciary duty will arise. Now, discretionary account managers, trustees will owe fiduciary duties to their clients. In other circumstances, the question of whether a fiduciary duty arises will involve the consideration of several factors. They're set out there on the slide, but very briefly, is the client vulnerable? Are they of an age that makes them more vulnerable to potential abuse? Are they inexperienced in investments? Those types of things will make them more vulnerable to an advisor's advice. How much trust is reposed in the advisor by the client? How much trust does the advisor take on? How much reliance is there? Is there a history of reliance? Are there special skills or knowledge that an advisor advertises, that the client can rely upon? The fourth factor is discretion. This is a very important one. The greater degree of power or discretion the advisor has over a client's account, the more likely it is that a fiduciary duty will arise. And finally, professional rules are often looked at to determine what the industry expects of an advisor, which will inform whether a fiduciary duty exists or not. Really, the key question is whether a client expects and relies upon their advisor to act solely in the client's best interests, which, from a practical perspective as well as a legal one, results in potential vulnerability of that client to abuse by the investor. And where fiduciary duty is owed, an advisor must act in the client's best interest to the exclusion of all others, including their own financial interest or otherwise, as well as third-party interests. Now, if we go to the third slide, in the trust sphere, as I mentioned a moment ago, trust professionals, trustees, trust officers, anyone who is managing trust property for the best interests of a beneficiary will owe a fiduciary duty to those beneficiaries. In the trusts world, or in the managing trust property world, there is an additional duty to account, and that has been codified in both statute and expanded upon in case law. One well-known case is the Zimmerman decision from 2010. And in essence, the duty to account is a trustee must keep complete and accurate records of all dealings with trust property. So at the end of the day, they can show that they have managed that property, assets, money, whatever, for the benefit of the beneficiaries. In practice, we are seeing that in addition to the duty to account, which normally comes to a head at the end of an engagement, trustees are increasingly being asked to provide frequent and intensive reporting on their activities, which relates in part to the growing size of estates, which we'll talk about in a bit. Courts have been supportive of these requests, we found, and so we're advising our clients in this space to take steps, to the extent they're not already, to put them in a position to respond quickly to these types of requests for reports and to be really detailed in documenting what they're doing with trust property on a day or weekly basis.
Thank you, Mike. That was insightful and also summarizes some of the things that professionals should keep in mind when entering into those engagement letters so that they know what are the duties they're looking to meet. Can you maybe tell us a little bit about what are the particular obligations a professional should keep in mind when taking on a client?
Yeah, in the advisory world, there are two main obligations that will inform the standard of care that is expected of a professional. There's the KYC, or know your client obligation, and the suitability or know your product obligation, as it's sometimes called. We'll start with KYC. This is the obligation to take reasonable steps to learn and remain informed of the essential facts that are relevant to every account and client that an advisor accepts. The question of what's essential will depend on the nature of advice and services provided, but CRO has provided commentary on this obligation and the categories of information that are required to be collected and maintained through the relationship. And they're set out in those bullets there. But briefly, personal circumstances. What is your client's age? What is their employment status? Are they married? How many dependents do they have? All of those things matter to knowing what your client's circumstances are. What are their financial circumstances? What is their annual income? What is their net worth? What are their liquidity needs? Are they using leverage to fund their investment portfolio, which is an important one? Investment objectives and needs. What are they looking, what's a client looking for in relation to the advice you're giving? Are they seeking to preserve capital because they're nearing retirement? Are they seeking to grow aggressively because they're young in their career and they're looking to ascend through the ranks of their organization? Are they looking to save to put a down payment on a house or to put their kids through university? All of those things will inform what a client's objectives are. What's the client's investment knowledge? How much experience do they have in the markets? How much do they know about the various types of investments you can make: equity, debt, derivatives, others? What is their risk profile? What is their ability to endure financial loss? Advisors should assess not only the ability, but the willingness to take on the risk of loss so as to potentially gain outsized returns. And finally, what is a client's investment time horizon? What is the degree to which a client is going to need to access all or a portion of their invested funds in order to meet short-term expenses or fund major planned expenditures? Now, that information is collected at the outset of any relationship, but case law and CIRO are clear that this is an ongoing obligation. So advisors are required to evaluate and regularly update their KYC information, particularly in response to significant changes to the client's circumstances. If they're getting older, if they take on a new job, or if unfortunately they're terminated, are they getting divorced? Do they have another kid? All of these things, advisors should be cognizant of these changes and be regularly asking questions to update their KYC information. If we go to the next slide, a corresponding obligation is suitability, or know your product. And this is the need to ensure that investments made by or for a client are both suitable, meaning that they align with the client's investment objectives and risk tolerance, which we talked about a moment ago, but also that the product puts the client's interest first. And in order to be able to determine whether a product is suitable, the advisor needs to know the product. They need to understand fulsomely the features of the product, its strengths, its weaknesses, and most importantly, its risks. This is in CIRO Rule 3402, and CIRO has provided guidance with respect to this obligation as well. A suitability determination, an advisor is only expected to do so based on information that is reasonably available at the time. In addition to contemplating specific risk profile of the product, you need to look at the risk that a product may have on the overall portfolio in terms of things like concentration risk or liquidity risk. So both from a position specific and an account general perspective, is this product suitable? Advisors are not required to consider external account information, including other investments held with other advisors, unless the advisor has specifically taken on that responsibility. Now, I will say that that is somewhat inconsistent with CIRO's expectation that advisors should consider the relative size of either a position or an account as against their total investments when assessing risk capacity. And so we tell our clients in practice, it's better to have more information than less, even if that information isn't used to assess suitability within the portfolio you're managing or advising on. It will help you have a more fulsome understanding of your client's financial picture and make sure that you are discharging your obligations under your duty of care or your fiduciary duty, as the case may be. The suitability analysis is generally 3 steps. It's set out in all sorts of cases. More recently, a 2023 CIRO decision in White. And generally, it's more than just filling out a form or telling a client there is a risk associated with the product. You need to undergo your due diligence. So you need to make sure that you've discharged your KYC obligations. And within that context, you need to analyze the proposed product. You then apply your professional judgment to determine whether the product matches the client's risk tolerances, both position-wise and account-wise. And then finally, you need to canvass the risks as well as the benefits with your client and make sure that they understand exactly what it is that you are recommending. And one other point on the obligation to put the client's interest first. Even if a position is suitable from a risk tolerance perspective, advisors are required to consider a reasonable range of alternative actions that would accomplish the same goal and ensure that the action they're recommending puts the client's interest first rather than the advisor's own interest or other competing considerations, such as a proprietary product that may be more beneficial to the dealer or the advisor. And as with the KYC obligation, to finish this off, it is an ongoing obligation. So as you update KYC information and things materially change in your client's life, advisors need to look at whether the portfolio as composed remains suitable given the changes to their clients' investment objectives and risk tolerance.
Thank you, Mike. It's really important to keep in mind that these are ongoing obligations so that not only you can continuously determine how to meet the needs of your client, but also set some expectations for your clients on an ongoing basis. And so, with that, now that we know what the duties are and what obligations professionals need to ensure before they enter into engagements on an ongoing basis, what are some of the areas in your practice that you're seeing, Mike, where there are risks that professionals are facing or areas where litigation, there's an uptick? Perhaps you can tell us a little bit about what you're seeing in your practice.
Of course. There are three things we can review quickly. The first, if we go to the next slide, not surprisingly, is cryptocurrency and fraud. So cryptos, it's the talk of the town. It has been for a while. Crypto and crypto-related companies like a MicroStrategies or something like that are becoming more popular as investors are looking to alternate sources to grow their wealth. Crypto remains relatively novel as an asset class, and it is believed, despite the risks, to provide outsized profits in relation to more conventional investments like equity or debt investments. And this mania around crypto has really created a perfect landscape for fraud. You have vulnerable investors who don't understand the product. You have promises that are being made by random people on the internet of outsized returns. And sometimes that's just difficult to resist. And as a result, we are seeing more and more issues where clients have fallen victim to a scam and are looking to recoup the money they've lost from any and all pockets they can get to, including their advisors or their banks. One recent case is the Zoo and Index decision that's on the slide there. That was a case where, similar to most we're seeing, a client of Index, which is a crypto trading platform, was looking to transfer crypto to a third-party wallet because they had been promised great returns if they did so. They were warned on a number of occasions about the risks of transferring crypto to an unknown third party and the fact that the transaction can't be reversed. Those warnings were ignored. Of course, the funds were unfortunately lost to the fraudsters, and then the plaintiff turned around and sued the platform and alleged that she wasn't properly advised of the risks of investing in and transferring cryptocurrency. Now, the platform was completely successful in defending these allegations. The documentary record was very clear that multiple warnings were given. But it is an example of the fact that the reality that where someone has been scammed, they are going to try whatever they can to get their money back. What we have been seeing so far is mostly within the retail bank space. So where a personal banking customer will advise that the bank hasn't warned them about transfers out to third parties. But it's not hard to see where a similar claim might be brought up in the advisory context. For instance, where an investment advisor is alleged to have failed to ask about crypto holdings with the result that they haven't properly assessed the suitability of a portfolio as against the whole of a client's investments. There might be a situation where an unusual liquidation request is made and funds are transferred out and inquiries aren't made about the purpose of those funds. Whether or not there's a duty to make those inquiries, that won't stop the allegations from being made. And so there is a risk we see here, and I expect it will come up in the advisory context in the short-term future, where those allegations will be brought against advisors. This is something that's got the attention of CIRO as well as the federal government. Recently, the budget that was released has information about both a financial crimes agency, which the government wants to set up in light of the $650 million that Canadians lost to fraud last year. The details of this agency are still very much in their infancy, and whether it gets off the ground, who knows? But it is reflective of the fact that the government is cognizant of the growing proliferance of fraud. And there's also a proposed framework for stablecoins. Stablecoins on their own, they could be an entire presentation, but in short, they are a fiat currency-backed crypto token that are intended to be a safer alternative to the cryptocurrencies that are out there now. The interesting thing about stablecoins is they are a payment mechanism, which at least in Canada are regulated as a derivative, with the result that ostensibly a stablecoin could become part of an investment portfolio, which is going to impact an advisor's suitability and know your product obligations. Advisors are going to need to be familiar with stablecoins if they become a thing, to make sure that they are advising their clients of the risks and potential upside accordingly. If we go to the next slide, please. Briefly, of course, market uncertainty. That's always an issue, but it's becoming more and more relevant these days with everything that's going on with our neighbors to the south, the interstate conflicts that are going on around the world. More locally, the housing market in Toronto, and increasing concerns regarding over-leverage, an aging boomer population, which we'll come to in a moment. All of these things can impact the volatility of the markets. And it's long established in the case law as well as with the regulators that an advisor is expected to identify and disclose reasonably foreseeable adverse conditions or risks that are material to an investment decision. The Rhodes and Prudential case is an oft-cited example of that expectation. This case dealt with the October 1987 stock market crash, Black Monday, and an advisor had put clients into a growth-based equity mutual fund, getting out of GICs and moving them towards this more growth-oriented product. And the court found that the advisor had failed to properly advise his clients of the particular vulnerability of these mutual funds to decline in value in the event of a market turn. And a more recent case in Harrigan, an MFDA decision when that still existed, an advisor had recommended a highly leveraged strategy and again had failed to understand and therefore advise of the risks associated with that product in the event of a market downturn. And it's not that an advisor is expected to predict what's going to happen in the markets tomorrow, predict the next Black Monday or something like that. What they are expected to do is recognize where particular products will be overly vulnerable to a market downturn and make sure that they are advising their clients of that risk and factoring that into their suitability determination with any of these products. And then I mentioned aging boomers a moment ago. Let's go to the next slide, please. The third thing we are seeing more and more is increased involvement by advisors in estate litigation. And this is likely a consequence of boomers growing older, estates growing larger, estate disputes become more contentious as a result. And there's an increased frequency we're seeing of several things. The first is allegations of elder financial abuse and undue influence are becoming more prevalent. I don't think that's because it is becoming more common. Rather, I think that people are becoming more alive to the issue, particularly as estates grow bigger. We are seeing more and more advisors are being summoned as witnesses in capacity disputes. So even if the advisor or the dealer is not a party, they're being called to give detailed evidence of their interactions with an elderly client who is suspected or alleged to have lost the capacity to manage their investments. And finally, we are seeing, and this has always been the case, but again, more increasingly these days, hindsight criticism of investment strategies that were employed and recommended to elderly clients, usually after the client has passed and the estate is being litigated. And all of these issues, the risk that they pose to an investor, an advisor, is the fact that it's difficult to contest allegations of wrongdoing without the benefit of being able to get evidence from your client, either because they no longer have the capacity to do so or because they have passed. And so, in light of this increased involvement in estate litigation, we're telling our clients and advising them to take certain steps to put them in the best position they can be to deal with the possible event of being brought into litigation as a party or a witness.
Thank you, Mike. As new areas develop, there's always increased risks when uncertainties and are in the market and regulatory landscapes are not as well developed in certain areas, such as crypto. Now that we've scared all the professionals on the risks that they face in litigation, what are some of the tips that you can give them to minimize those risks, and what can they do to minimize their liability?
There are a few things that we advise clients to do regularly and are advising them to do more so now. I mean, the unfortunate reality is you can't avoid litigation entirely. People can and will sue for everything, particularly when you are a deep-pocketed party. But there are steps you can take to put yourself in a strong position to defend any allegations that might be brought by disgruntled or desperate clients. First, document everything. Notes are often the most important evidence we have when we are defending litigation claims against advisors. The more detailed, the better. Notes are a contemporaneous record of client interactions. They will not have been influenced by the allegations made in the litigation or the contentious dealings between the parties in the moment. And so, for that reason, they will almost always be preferred by a judge to hindsight recollections given by either advisor or client in the context of active litigation. Be particularly careful to document instances where clients proceed against your recommendations or where they are taking on a higher risk asset. And that relates to, in part, to the next tip, which is adapt your KYC collection process to what's going on in the markets. Ask specific questions about other assets, including crypto. You may not have an obligation to take on or take consideration of those assets when making your suitability determination, but it will help you identify potential issues and get ahead of them in the event that you think your client is making a foolish decision, and you can protect yourself accordingly. Regularly update your KYC information. Everybody does this already, but don't be beholden to your internal compliance calendars or your regularly annual or biannual scheduled meetings with your clients. Be alert to material change in their circumstances. In particular, look for out of the ordinary instructions that could indicate a life change or potentially an issue with capacity or undue influence. Regularly reassess suitability. Review your portfolio following material client changes or significant market moves, not just when adding new positions. Again, this is something that most advisors are doing, most dealers are doing, but it bears mention in light of the risks that we just went over and the particular market uncertainty that is going on right now. Watch for red flags. So we've talked about unusual trade requests that don't align with client objectives and risk tolerance. Look out for increased liquidity needs or significant withdrawal requests. These could point to any number of issues, but be alive to them and ask questions if something is out of the ordinary. Look for signs of undue influence. Look for signs of elder financial abuse. Look for diminished signs of capacity, forgetfulness, unusual behavior. A lot of advisors won't be trained to deal with these things. Trust professionals may be more alive to them or familiar with them. But if you think something's amiss, get in touch with compliance, get in touch with your internal legal department, ask the question and raise the issue. And that way you're going to best protect yourself and put yourself and your firm in a position to weather the storm in the event of litigation. And finally, I started with it, I'll end it with it. Please document everything. Please take notes. It makes litigation so much easier and makes defending claims so much stronger. And that's what I've got to say.
Yeah, definitely, I can echo that. Document everything. It makes our lives and your lives way more pleasant when you're actually in litigation, and also helps, jog memories and certain timelines when we're trying to defend any professional advisor. Now, thank you so much, Mike. One of the areas that is the talk of the town is artificial intelligence. all professionals are trying to figure out how to use artificial intelligence and what to do with the development of artificial intelligence. Now, before we sort of dive into the regulatory landscape, Kelly is going to walk us through a poll and get some thoughts from the audience.
Yes, thank you, Deep. So we do have a poll here, and its purpose is to find out how AI is being used in your organization, in what way. So if you see that pop up on your screen, please fill it out. And just while you're doing so, I will mention that there was a 2023 report by the OSC and E&Y that did canvass capital market participants about how they are using AI in their organizations. And there was 4 key insights. The first was market insights. So that's basically using AI systems to extract insights from large volumes of data, analyzing financial reports, news articles in order to detect trends. The second area was back-end support. So that's automating reconciliation, trade surveillance, and fraud detection. The third area in which AI is being used is predictive analysis, and that's risk management to predict liquidity risk based on historical trading and market volatility. And the last key area was in customer service. So that's basically using AI to communicate directly with customers, whether that's through a chatbot, and also to consider investment recommendations for their portfolios. So with that said, can we see the results of the poll? All right, what have we got here? So how is your organization currently using AI? Go ahead. We have 63% with pilot use, experimental, 35% with operational, so AI is actually embedded in processes and supports processes used daily, but humans make all final decisions. 5% proprietary AI tools and decision making, and 8% AI is used in marketing and sales, and 20% ad hoc or unofficial AI used by employees. Those individuals should contact us after the presentation.
I was gonna say, that's a way higher number than I would like as a litigator.
Please reach out.
You know, that's what keeps us in business, I suppose.
That's right.
Now that we have a little bit of an idea how our audience is using AI in their day-to-day work and businesses, what is the regulatory landscape, Kelly, that they should keep in mind or know of as they embed AI into their professions?
Sure. So the most important thing to know is that Canada does not currently have federal legislation governing the design, development, and deployment of AI systems in private industry. So we are not the EU. We do not have any sort of federal law governing AI use. I will just mention briefly that there was a proposed legislation, the Artificial Intelligence and Data Act, which we called ADA, that was introduced as part of Bill C-27 back in 2022. And that was going to, on a federal level, regulate AI systems in Canada. ADA unfortunately died on the order paper earlier this year when the election was called. But I think it's helpful to look at some of the key themes and areas that ADA was going to regulate, just from a general perspective, as well as if there is any new federal legislation introduced in this space, it may basically pick up from where they left off. So key requirements under ADA included risk assessment and mitigation. Organizations were obliged to assess harm and implement obviously risk mitigation strategies. There was governance and accountability requirements to have internal processes and, as Mike mentioned, record-keeping practices in place to show how organizations were mitigating risk. There was, of course, incident reporting and monitoring. So organizations were required to report serious incidents and harmful outcomes as a result of implementing AI systems. And then finally, there was going to be an enforcement arm under ADA. So there was going to be a new AI and data commissioner that was going to oversee compliance and administer monetary penalties for violations. Again, we don't have ADA in place, but one criticism of ADA when it was going through the House was that there was no actual definition for the high impact systems that were being governed under the legislation. It was ambiguous and it was to be left to the regulation. So that's something I will come back to when we go through the guidance that is existing at the moment for financial services industry participants. So basically, without the use of the federal legislation, we do have guidance from regulators on how to implement AI systems into our organizations. The first one that you see on the screen there is the OSFI guideline E23 model risk management, and that was published in September of this year, and it becomes effective May 1st of 2027. So basically, the purpose of the OSFI guidelines is to provide organizations with a principle-based framework that sets out the regulator's expectations for effective model risk management. So that's using a risk-based approach. It of course applies to all federally regulated financial institutions that are integrating AI systems into their operations. And unlike ADA, it does contain an actual definition for AI systems. And they're basically using the OECD definition, which is machine-based system that for explicit or implicit objectives infers from the input it receives how to generate outputs such as predictions, content, recommendations, or decisions that can influence physical or virtual environments. So that's quite a mouthful, but basically it includes all large language models, so LLMs, as well as generative AI models. So those are models that create new content based on their inputs, such as GPTs. So OSFI has three main outcomes from the model risk management approach that it uses in its guidance. The first is that the model risk is well understood and managed across the entire organization. So this means that the expectation is that senior management and the model stakeholders, which are the owner, developer, reviewer, and approver, those are all defined terms in the guidance, those individuals will understand the AI's model use, limitations, and the potential for negative outcomes. So this means that when you're going to implement an AI system into your organization, it requires assigning roles and responsibilities to those individuals prior to implementing the AI system and ensuring that there are sufficient resources allocated to manage risks. The second outcome for model risk management is it's using a risk-based approach. So that basically requires the model to have a risk rating attached to it to reflect the vulnerabilities and the materiality of the impacts. The type of factors that go into applying a risk rating include quantitative factors as well as qualitative factors, such as the complexity, level of autonomy of the model, reliability of the data. Now, remember, the risk rating can change throughout the life cycle of the model, and it should be revisited at least on an annual basis. The third main outcome from the OSFI guidance is establishing model governance over the course of the model's life cycle. And that requires implementing, obviously, policies and procedures that cover the full life cycle. And the risk management intensity should match the model risk. So obviously, the higher risk of the model, the need for stronger controls. So basically, the takeaway from the OSFI approach is that the organizations themselves are ultimately accountable for the use of the AI model and are expected to assess and understand how the AI model may impact their risk profile. We can go to the next slide. So the next guidance that I'll refer to is from the CSA, and that was published in December of 2024. In CSA Notice and Consultation 11348. And basically this clarifies how existing security laws apply to AI and what the regulators are paying close attention to when AI systems are being implemented. And the CSA, similar to OSFI, uses the OECD definition of an AI system. So the key themes from the CSA guidance are, again, governance and oversight. So having those policy and procedures implemented to address the unique features of the AI system. And CSA refers to having a human in the loop, which means that there's an actual human standing behind the AI system who monitors the inputs and outputs. And that individual should have sufficient training on the AI system as well. And that kind of leads into the next theme from this guidance, which is explainability. So the organization and the human in the loop needs to be able to explain the factors that were used to create a given outcome and the weight afforded to each of the factors. If there's a high level of explainability, it means that the AI system's reasoning is clear and comprehensible, and that helps demonstrate the accountability of the organization in using the system. Another key theme is, of course, disclosure, and there's a warning from the CSA about market participants making inaccurate, false, or misleading statements or embellishing claims to attract investors to capitalize on the current frothiness of AI in the market. This is what we refer to as AI washing, which I will come back to when I discuss litigation risk. And then the fourth theme is conflicts of interest. And this is ensuring that the AI system, once implemented, does not reflect conflicted decisions. So this includes being aware of any biased data in the AI system that could lead to adverse outputs. The guidance does go into specific areas for registrants, and that includes advisors and dealers. There they say that there has to be, again, human oversight for any investment recommendations that you're using AI to assist with. Otherwise, if there's no human oversight, then you won't be able to tick that explainability box, and you have to be able to demonstrate the sufficient understanding and control of the decision, any decision that's made on behalf of a client. There also needs to be clear disclosure on the AI use and risks for advisors and dealers in line with what Mike described earlier, which was the duty to act fairly, honestly, and in good faith. For investment fund managers, the using AI needs to meet the fund's objectives, and that needs to be disclosed in their offering documents, stating the objectives, strategies, and processes. And that includes you defining AI in the offering document and explaining its role in the fund and the risks associated with it. We also have to consider, coming back to AI washing, how AI is being referenced in sales communications. So that's anything being put out on websites or social media to ensure that there's obviously no misleading statements and that you're not exaggerating the extent to which AI systems are involved. For non-investment reporting issuers, the guidance is mainly directed at continuous disclosure obligations. So that's your MD&A, your AIFs, and applicable prospectus filings. Again, for disclosure, the emphasis is on disclosure of AI systems in a factual and balanced way and providing specific insights on the operational impact and risk portfolio of the AI system. And then the other thing to keep in mind is forward-looking information and considering whether any statement concerning AI is forward-looking information, and if so, disclosing those assumptions that are used to develop it and the material risk factors should also be disclosed. So the CSA did have a consultation period attached to their guidance, which is now closed. It closed in March, and CSA is reviewing the feedback to determine if there will be any updates to the regulatory framework as needed. We can go to the next slide. So I've gone into detail on the OSFI and CSA guidance. I'm just going to touch very briefly on some other guidance from regulators that could impact AI systems. The first is the Voluntary Code of Conduct, and this was from ISED, released in September 2023, and that's for all companies and organizations that are using AI systems that need to demonstrate responsible development and management for generative AI. And these are just a principle-based framework for them to implement when implementing the AI system. It includes accountability, safety, fairness, transparency, human oversight, validity, and robustness. So all themes that we've already discussed. The other piece of the regulatory scheme is the privacy, and specifically the use of personal information in the inputs for an AI system. The OPC, the Office of the Privacy Commissioner, released guidance in 2023 that applies to developers, providers, and organizations using AI systems, and that's with the collection, use, or disclosure of personal information. So the OPC's guidance mainly reflects many of the privacy principles that you may already be familiar with from PITA, but those include consent. So if it is determined that the legal authority for collecting, using, and disclosing the PI is consent, then that should be documented. And where consent is needed, you should ensure that you're obtaining consent in a valid and meaningful way. Another privacy principle that applies is the necessity and proportionality principle. So before using PI in the AI system, it must determine whether it is truly necessary for the purpose it was collected. And also consider if there's any way to not use the PI itself, but to anonymize or de-identify that data before it's used in an AI system. The other privacy principles are similar to the ones that were discussed earlier in terms of accountability, transparency, limiting the collection, use, and disclosure of PI, as well as having safeguards in place to protect personal information commensurate with its sensitivity. So the more sensitive the information, the expectation is that the more stringent the safeguards will be to protect it. So some of that information that Mike was describing earlier in terms of collecting for KYC forms, the more sensitive financial information, marital status, the expectation is that the safeguards protecting that information will be even more heightened. The last principle is fairness and bias, and that's considering whether the training data used for the AI system contains bias or unfair representations. The last thing I'll say about privacy is that you should be aware about Quebec's privacy law, which is Law 25, and that does require heightened transparency around AI systems using personal information. So that's sort of the high-level overview of regulation of AI systems in Canada.
Thanks, Kelly. It is definitely very helpful, especially in light of the fact that there's dearth of federal legislation that we've seen so far. What are some of the risks in litigation that you're seeing as companies start using AI in their businesses? Perhaps you can tell us a little bit what you see in your day-to-day practice.
Sure. So when we're looking at litigation risks, because AI is so new to the market, we don't have a lot of reported decisions, either regulatory investigation reports or reported case decisions that deal with AI specifically. So instead, we're kind of looking at trends in AI litigation. And one of those trends, if we go to the next slide, is what I mentioned earlier, which are AI washing cases. And these basically involve organizations and in some cases executives who misrepresent the use of AI in their products, services, or operations in order to gain a market advantage. AI washing is similar to what we see on the ESG side with greenwashing, although that is a little bit more advanced in terms of regulatory investigations and decisions, but it invokes some of the same ideas. For AI washing, we look to the US to see where some of the emerging trends are and what we can expect here in Canada. The examples I have up on the slide, the first one is Upstart Holdings, which is a class action, securities class action that was filed in the Southern District of Ohio. And basically, Upstart promoted its AI underwriting model as a superior to traditional models in evaluating prospective borrowers and determining whether to issue a personal loan. Company went public in 2020, and the stock continued to climb, with the company and the executives touting the strength of the AI model and its advantages over traditional models. Of course, revenues dropped when rising interest rates caused a decrease in loans by the platform due to the increased cost of borrowing, and a securities class action followed by investors who claimed the company had engaged in misrepresentations, causing them harm. So this all went to a motion to strike in September of 2023, where Upstart was basically unsuccessful in striking claims related to its statements that it had a significant advantage with its AI model over traditional models, and that the company had the ability to respond very dynamically to macroeconomic changes. The court basically found that these statements were sufficiently alleged to be false based on the claim that the AI model did not provide these advantages in general or in times of macroeconomic turbulence, such as increased interest rates. And I would note that this action was certified earlier this year, but no trial decision. The SEC has also been active in the AI space, and that's the second bullet, I think, on the slide. And this is Delphia and Global Predictions, Inc. The SEC settled charges against those investment advisory firms for misleading statements about their AI capabilities. Delphia, in particular, claimed it put collective data to work to make its AI smarter so it can predict which companies and trends are about to make it big and invest in them before everyone else. Global Predictor claimed to be the first regulated AI financial advisor, and that it would use AI-driven forecasts to inform investment recommendations, all of which turned out to be false. Both investment advisor firms settled charges brought by the SEC and paid monetary fines in the amount of $400,000. The last one I have on the slide is DocGo, Inc. And this is where this was a class action filed in the Southern District of New York, and a CEO falsely claimed that he earned degrees in computational learning theory, computer science, and law when he in fact had earned no such degrees. The company claimed it had a proprietary central AI system that managed the logistics behind scheduling patient interactions and resource allocation. And investors eventually filed a securities class action alleging materially false and misleading statements. The motion to dismiss was heard by the Southern District earlier this year, and there the court found specifically that the allegations about the CEO's misrepresentations of his academic credentials were sufficiently pled, and that he had tied those educational credentials to his role in the AI technology strategy. So his made-up degrees was being used basically to market the underlying AI technology. And that made the false credentials more than mere puffery and could ground the allegations. So this case shows that executives' educational background may be material under securities laws when it's tied to AI credentials. Last slide I have, if we go to the next one, these are just basically some key takeaways on potential litigation risks, most of which I've already described. They come from the OSFI and FCAC risk report from September of last year. And basically they highlight key risks that arise from financial institutions using AI, both internal risks, so includes AI for critical use cases such as pricing, underwriting, claims management, trading, and external risks. And really what we're looking at external risks is cybersecurity and fraud from AI systems that is becoming more prevalent and more harder to identify. So as far as litigation risk goes, it's again those privacy and consent risks and the potential for privacy class action if mitigation efforts aren't taken to address the risks by disclosing AI use of PI and obtaining informed consent. There's also ethical and reputational risks of bias in AI that can persist without personal identifiers, and institutions must monitor their models to ensure representative data and involve diverse teams to mitigate legal and reputational risk. The last one is the third-party risk, where organizations need to remember that they are ultimately responsible for the results of any third-party AI system that they use to sell and promote their products. So that's kind of an overview of what organizations should be aware of in terms of litigation risks moving forward.
Thank you, Kelly. Let's see if we have some questions from the audience. While we wait for audience questions, I had a question while you were talking about third-party risks and that organizations are ultimately responsible for results of their AI systems that they use in their products and services. What are some of the steps that organizations can take to mitigate that third-party risk?
Yeah, and I mean, we see this come up in the privacy context quite often. Really, it's all about getting the third-party vendors' terms and conditions, their T's and C's, and reviewing them very carefully. In the AI context, you're looking at how is the information that you're providing to the third-party vendor being used? How is the third-party vendor training its model? Is it using the personal information that you're providing it with? And one bucket of personal information that I didn't talk about was employee personal information. So there was one instance where a third-party vendor was going to take basically all of the organization's employee information, personal information, and use it to train its model for its chatbot service. So those are some of the things you want to be aware of and think about mitigating those risks, such as can you anonymize or de-identify that personal information before it's used for training purposes.
Okay. Thank you so much, Kelly, and Mike for joining us today. And if anybody has any questions, I see there's one. Can you speak to AMF's guideline on AI? Is it similar to OFSI's E23 guideline?
Yeah, I didn't actually get to the AMF guideline. I mean, it does raise basically the similar concerns and buckets that I talked about earlier, not just with the OSFI guideline, but also the CMA, CSI, sorry, guidelines as well. So it's all of those accountability, transparency, disclosure.
So I'd say the theme of sort of the professionals to take away, I would say, is document, disclose, and ensure that you are on an ongoing basis meeting all of your obligations with your clients, discussing their portfolios and considering how risks are impacted. But definitely disclosure and documentation seem to be the highlights, whether it's AI use or whether it's good old fashioned human recommendations by professionals. If anybody has any questions, please do not hesitate to reach out to Mike, Kelly, or any of your relationship lawyers at Dentons for any further insights. And we welcome all thoughts that you guys may have. And hopefully you found the presentation insightful. We would also love for you to join us for our next webinar in our series, which is unpacking key risks and exclusions in professional liability for architects and engineers, which is scheduled for December 3rd at 12 p.m. You'll get those invites as well in your inboxes. And as we said, thank you so much to Mike and Kelly today for sharing their insights with us and taking the time out from their busy schedules to provide us these updates. Thank you all so much.